Hello everyone. I am going to be speaking about exploring tax and regulatory regime for funds in the IFSC. So, as we all know, India's growth story is for everyone to see. I think my esteemed speakers have already spoken about how India is growing and so on. Actually, talk about how the taxation and the regulatory regime works for the investors and for the funds in the IFSC. I have also covered a few structures which we are popularly seeing being set up in the IFSC. So to get to it, my first slide is basically on what is IFSC. IFSC was primarily set up to attract foreign investors who have set up presence in Singapore, Mauritius, or everywhere else in the world, and encourage them to set up a presence in India itself, which is why you would see that the regulatory and the tax regime for funds in IFSC is quite comparable to the fund regimes available all across the world. The vision of the government of India to set up was to, as I was saying, to attract the foreign investors to come to India, and for the fund managers to set up a presence within India. As we speak, there are about more than 100 funds which have already been set up in the IFSC with a commitment of more than $20 billion as of September. And of course, the number keeps growing as we speak. These are all the options or the opportunities which the IFSC has to offer. As you can see, there is banking, there is brokerage, there is capital markets, there are funds which you can set up in the IFSC, there is insurance broking, and there is finance company. There are the entire fund ecosystem. So you have your registrar, you have your fund accountants, you have your fund admins. So all of them combined form the IFSC regime. And from the IFSC ecosystem, there is also something called as aircraft and ship leasing, which is also permissible from the IFSC. We will actually discuss more about the tax and regulatory regime through various structures which we have seen being set up in the IFSC. Yeah. This is the basic about what is the fund management regulations. As you can see, the fund management regulations were notified in 2022. The key benefit of this fund management regulations is they are now regulating the fund entity instead of the fund manager entity instead of the fund. So which means your single fund manager entity can now take multiple registrations and do multiple activities through the same license. So they can launch multiple funds, they can do fund management, they can do investment advisory, they can do portfolio management, all from the same entity once you take one registration. There is obviously a risk based. So if you are managing only accredited money or large investors' money, the regulation is quite light touch. But if you are intending to manage retail money, then the regulations are a little more stringent as compared to the light touch regulations. This is how a typical fund in the IFSC would look. As you can see, there is a fund which basically will pool money from the investors, and it will make investments into various securities. The investments can be made in the Indian securities, in the IFSC securities, as well as in the foreign securities. Right? You need to mandatorily have a fund manager entity in the IFSC. Okay, that fund manager entity can be formed by an entity in India or by an entity outside India. Both is possible. Once you set up the fund management entity, it will take a registration with the IFSC authorities. Then it can launch multiple funds. It can also do portfolio management directly for foreign investors through that fund management entity. So that is also something which is possible. These are some of the conditions which are applicable if you are set up in the IFSC. Now, in terms of permissible investors, if you are a non-retail fund or a AIF kind of a structure, then either it can be accredited investors or the minimum investment of $1.5 lakh would be applicable. In terms of permissible instruments, you can invest honestly everywhere across the globe. You can invest in India, you can invest in the IFSC, you can invest outside India as well from your IFSC fund. So that is a complete spectrum of securities which are permissible in which you can invest. Um, there are some investment restrictions if you are a resident Indian investor. Firstly, if you are a resident Indian investor, the fund cannot, and if you're investing in a GIFT City fund, that fund cannot invest back into India. It will be a round tripping. So that fund will have to either invest in the IFSC or outside India. The second is there are some restrictions. The investments can be made by individuals only under the LRS route, and the entities can make under the OPI route, which is about 50% of their net worth. And as we all know, the LRS limit is about $2.5 lakh dollars. That is the maximum investments you can make. There are you can, as I was saying, you can invest in unlisted also. You can invest in listed also. So it's the entire spectrum of securities which is available to you. And this is the first structure which we are looking at. This is basically a typical category 3 AIF structure. So you set up a category 3 AIF in the IFSC. You have a fund manager entity in the IFSC. You have foreign investors which are investing, and the AIF is investing into Indian securities. Because this is a category 3, your investments has to be in listed securities, more than 50%, right? Now there are several tax benefits if you set up in this structure in the IFSC as compared to a domestic or as compared to a foreign jurisdiction. The first benefit is all your non-equity gains, be it your debt, derivative, be it your IFSC securities, be it your security receipts, everything is exempt from tax, from capital gains tax in India. So if you're investing in any security other than shares of Indian company, it is exempt. So even if you invest in foreign securities, say US securities, that is also completely exempt from tax. Your dividend and interest income is actually taxable at a lower rate of 10%, which is a flat 10% rate, which is again, as you would note, which is quite comparable to the funds which are set up, say, in Singapore, Mauritius, or other jurisdictions. You get complete exemption on any income from foreign security. So if your GIFT City fund is pooling from non-residents, it is investing in US. The income you receive from US as well as the capital gains on the securities is also exempt from tax. Of course, if there is a US withholding on that income, that of course is something which could be a cost to the fund, right? So this is about fund. As I said, everything is exempt. Now, when it comes to fund manager entity, you have a 10-year tax holiday. Basically, the income of the fund management entity is exempt from tax in India for 10 years out of the first 15 years. And we have an option to select a block of 10 years. So if your fund manager entity is set up in 2024, you can claim exemption for any 10 years up to 2039, which is 15 years, but it has to be a continuous block of 10 years. Plus, there is no GST on management fees, performance fees, additional return, or any kind of variable return. So that is, of course, an additional benefit to the investors. There is no custom duty or anything if you import any goods to the FME entity. Plus, your foreign investors, who are investing in the GIFT City fund, they are neither required to take a permanent account number, nor are they required to file any tax returns in India, which is, I think, a very, very big benefit for these funds, because they would not be subject to Indian tax regime. Yeah. Moving on to the next structure, which is quite similar. The only difference being that this category 3 AIF is actually acting like a feeder fund to a domestic mutual fund, which we have seen a lot of mutual funds are showing interest. As I had already mentioned, because it is this feeder fund in IFSC is investing into a mutual fund in India, which is non-share. The entire capital gains on this would be exempt from tax. Plus, dividend income from mutual funds should be taxable at a lower rate of 10%. So, as you will see, the structure is quite efficient from a taxation perspective. Again, the other benefits like your no GST, management company exempt from tax for 10 years out of 15 years, that all of course will continue. This structure from a capital gains perspective is exempt through and through, because the AIF would not pay any tax in India, and the foreign investors, as I mentioned, they are not required to obtain PAN or file return. So they are also not taxable at all in India. So it's a complete through and through exemption structure. The next structure is basically if any investors is intending to invest into stressed assets, that again, to repeat myself, this is again because it is a non-equity security. The investment in securitization trust would be exempt from tax, from capital gains tax. In fact, any surplus, if there is any upside on the stress asset, that is also specifically exempted from tax. So your capital gains and your upside becomes exempt from tax. Your dividend and interest, of course, would continue to be taxable at 10%. But again, this structure is something we have seen in the market, and people are really exploring this for investment in stressed assets. This is basically your category 2 AIF, which is mostly for investments in private or unlisted shares. There are unfortunately no specific tax benefits of this structure from investors' perspective, because the income of the AIF is passed through, similar to a domestic AIF, where the income of the category 2 AIF would be a pass-through income. So the entire income is taxable in the hands of the investors. They are, of course, eligible to claim tax treaty benefits wherever available on the dividend, interest, or capital gains. The other benefit, again, as I was saying, is that even here, they are not required to obtain any PAN or file any India tax return. So the exposure, so if you were investing in a domestic category 2 AIF, which is outside IFSC, you would be as an investor, you would be required to obtain PAN, file India tax returns, and so on. But here, if the AIF does withholding at source, the foreign investors would not be required to do any tax filing or take any permanent account number or tax ID in India, which again makes the structure a little more attractive as compared to a domestic. Of course, your fund manager entity continues to be exempt from tax, and there is no GST, which of course also indirectly benefits the investors because they have to pay lesser amount of fees to the manager. This is a typical fund of fund structure where you are setting up a feeder fund in IFSC to invest in the fund in India. The biggest benefit of this is the exemption from PAN and tax filing, which a foreign investor would get, which it would otherwise not get if it were investing directly in the domestic fund. The tax regime, of course, there may not be a lot of tax benefits because your fund in India would have to pay taxes if it was a category 3, and if it was a category 2, then it continues to be a pass-through. The benefit of this structure is that you enjoy all the exemptions or all the benefits which are available to a domestic local fund, and as an investor, you also enjoy the benefits available to an IFSC fund. So it's beneficial for the investors plus for the fund as well. This basically is a quick summary of what we have discussed, the tax benefits. As we can see, a category 2 AIF is passed through, so income directly taxable in the hands of investors. Investors are exempt from taking permanent account number, filing tax return, but the taxability will still be there in the hands of investors. For category 3, as we discussed, there is no capital gains on any non-equity shares of Indian company. So all your foreign securities, your debt, derivative, bonds, everything becomes exempt. Your IFSC securities can become exempt. There is a special tax rate of 10% on dividend and interest. There is a 9% special tax rate if there is a bond of an Indian company which is listed on the IFSC exchange. So that is also, we have seen a lot of interest for Indian funds, Indian entities to list their bonds on the IFSC exchange. In fact, very recently, the IFSC authorities have allowed listing of shares as well on the IFSC exchange. It's still a little nascent, but when it does happen, the shares which are listed on the IFSC exchange may also be exempt from tax. So then there's a possibility we may get exemption on equity shares of Indian companies as well, if that shares are listed on the IFSC exchange. I'm presuming we'll see a lot of traction there as well. If there is an outbound fund, basically a fund which is set up in IFSC for resident investors which are investing offshore, then there is no exemption because that fund is for resident investors and we do not get any tax benefit there. The fund manager entity, of course, will continue to enjoy some exemptions, but as an investor, there may not be any tax benefit for an outbound fund which pools money from residents and invests outside India. If you are trading on the IFSC exchange, there is also exemption from STT, from commodity transaction tax and stamp duty, which reduces the cost of trading on the IFSC exchange to a significant extent. As a foreign investor, you can also directly trade on the securities which are listed on the IFSC exchange without triggering any India tax implications. So basically, if there are some bonds or debentures or derivatives or equities which have recently been permitted, which are listed on the IFSC exchange, as a foreign investor, you can directly trade in those securities without having the need to obtain a permanent account number or file any tax return in India. This is basically the benefit available to the fund manager entity. I think we briefly spoke about this. There is a 10-year tax holiday. There is no GST on the services which it provides to the fund. Plus, if you opt for a special regime which is applicable to a company in India, then there is also a possibility to obtain exemption from the minimum amount of tax, or MAT as we speak. So then your income of your company in the IFSC could be completely exempt with no MAT or no income tax for those 10 years. We spoke about the GST exemption, which is available to the fund manager entity, and which of course indirectly benefits the investors. Now this is basically a quick summary of why should we look at the IFSC as compared to some other popular jurisdictions. There are of course tax benefits. The other big benefit is the operating cost in IFSC is much lower as compared to a lot of more developed fund jurisdictions. The rent cost is very low. The employee cost is very low. So you have a substantial operating cost savings as well. Plus, if you are investing through a gift fund, there is no requirement to obtain any tax treaty benefits. Basically, your entire income is exempt from tax under the domestic tax laws, or you get a lower tax rate under the domestic tax laws itself. So the entire question of applicability of anti-abuse provisions, be it MLI, be it the Indian domestic GAR, that all will not be applicable. So that I think is a very big benefit, because a lot of us may have seen that the Indian authorities have been looking at offshore structures quite rigorously, and they have been asking a lot of questions. But if you set up in the IFSC, there is no GAR, there is no MLI, so claiming exemption and claiming lower rates becomes much simpler. There is of course tax savings, there is GST savings, but the operating cost and the no GAR MLI applicability also is a very big advantage which these funds in IFSC would enjoy. This is my last slide probably. You can, if you have a fund which is set up in other jurisdictions like Singapore, Mauritius, or any other jurisdictions, you can actually relocate that fund to the IFSC. That is something which the government has allowed. You have a deadline of 31st March 2025 to relocate your fund. The best part about that is your relocation is completely exempt from tax in India for the investors as well as for the fund. So if you are holding securities currently in, say, your Mauritius fund, you can transfer all those securities to the GIFT City fund at no additional cost, no transaction cost, because there is an exemption from STT as well. There will be no tax cost for the fund or for the investors. It's a complete, you are allowed to completely, shift your securities with no additional tax implications. And in fact, if you have some shares which enjoy grandfathering benefit in your Mauritius, that also continues to be exempt for this relocated GIFT City fund as well. So this is something which all of us can look at in case you want to relocate your fund from offshore to IFSC. This is a brief process to set up a fund in IFSC. Basically, you need to set up a fund manager entity and fund. You need to take approval from the SEZ authorities in India, from the IFSC authorities in India. Then, if you want to invest in India, you need to also take something called as an FPA registration. The moment you do that, your entire fund would be set up after all the approvals, and you can start trading in India. In case you are looking to relocate your funds, there will be one additional step to shift your investments from offshore jurisdictions to India. You can also actually do PMS from India, from the IFSC. So if you have some foreign investors which wants to invest in India, but they don't want to come into a fund, you can also do PMS for them. So basically you can manage their portfolio from the IFSC and they can make investments in India. A reverse is also possible where your residents in India, if they want to invest offshore, that is also something which is permissible to be set up in the IFSC. Yeah, I think that's it from my side. Thank you.